Call the Committee on Taxes to order, and good morning, everyone. And did you notice the new chairs, everybody?
Yes.
Very
Saw
nice.
salt yesterday.
So, very good. Welcome back. Representative Carlson.
Mr. Chairman, if you'll recall, I raised a question when we had a joint Republican DFL caucus on training a year or so ago, and I requested new chairs, and the speaker at the time, Representative Dowd, indicated that he would put them on order.
And
I feel I did have a minor, because he agreed at the time that he would get new chairs ordered.
it looks like Representative Dowd did follow through, so thank you. We do have a quorum, and we do have some minutes. And anyone care to move the minutes? Representative Erickson?
I'll move approval of the minutes from January 17.
Representative Erickson moves approval of the minutes for January 17th. Any discussion on that? If not, I'll call for the vote. All those in favor say aye.
Aye.
Those opposed say nay. Motion carried. The minutes are approved. Okay, so today we are going to have an overview of tax conformity. We've heard quite a bit about that. It's something we worked on last year. This is in response to the Tax Cuts and Jobs Act that was passed December of 2017. And so, especially members who were not on this committee last year, you've probably heard federal taxable income, you've heard federal adjusted gross income, and all those different types of things. And so that all has part of this, and the Tax Cuts and Jobs Act certainly will change behavior for Minnesotans. And, you know, there are some things that we will, as happened last year, things you will want to conform to. There will be some things, which is a policy decision, that you will not want to conform to. So to set out kind of a broad kind of understanding of what this conformity thing is all about, we've got Mr. Williams and Mr. Clayman to start with a presentation. So if you want to begin, and welcome.
Thank you, Mr. Chair and members. For the record, I'm Sean Williams from the Nonpartisan Research Office. So I'm going to start today by talking about, at a very high level, what is tax conformity. So I covered some of this content in a sort of shorter form last week in the tax overview, but I think it's probably worth going through it one more time because it takes a while to set in. So first, Minnesota's income tax code uses federal taxable income as defined in federal law as our starting point. And so our tax calculation sort of relies on the federal law for, calculating sort of some certain definitions and certain calculations. We're also a static date conformity state, which means that our tax code sort of adopts the federal code as amended through a particular date. So right now, Minnesota's tax code is tied to federal code as it was amended through December 16th, 2016. Since that date, there have been sort of three tax laws that have taken effect at the federal level, one which is particularly had a particularly large effect. So there's the Tax Cuts and Jobs Act, TCJA, that was enacted in December 2017. There's also a Bipartisan Budget Act, that was the name of that law, passed in March 2018 that made some changes, particularly for tax year 2017. And in September 2017, there was a disaster relief bill that included some sort of tax provisions for people living in disaster areas. So we have not yet adopted the changes to the federal tax code that were made by those three laws.
And Mr. Williams, Mr. Clayman, for members, if you want to ask questions as they're going on, please feel free to do so.
So I showed this slide as well. This is sort of last week, but sort of to go through it one more time. Our tax code right now starts at federal taxable income as the sort of breaking off point from the federal code. So that means that it's after sort of adjustments to income or above the line deductions. So that's things like the student loan interest deduction, the moving expense deduction, contributions for IRAs, those sorts of things are calculated above the line. That gets you adjusted gross income at the federal level. Then you apply either the standard or itemized deductions and your personal or dependent exemptions, and that gets you federal taxable income. And as I'm going to talk about a little bit, the Tax Cuts and Jobs Act in 2017 made changes to both above-the-line deductions that affect adjusted gross income. It also repealed the personal and dependent exemptions. and it made significant changes to both the standard and itemized deductions. So sort of the federal definitions of both adjusted gross income and federal taxable income changed pretty significantly as a result of that law. So no matter where our tax code sort of starts from federal calculations points, there are some changes we probably would like to adopt. And particularly if we stick with federal taxable income, there's pretty significant changes. One other thing I highlighted last week, but I'll say it again because it's worth reiterating. Prior to the 2017 law, the sort of tax code adjusted for the size of your family before calculating federal taxable income through the dependent exemption. But after that law, because the law repealed the dependent exemption and replaced it with an increase in the child tax credit, sort of the family size adjustment that we previously kind of adopted from federal law sort of no longer flows through to Minnesota. So sort of a big policy decision. It's sort of a function of where we break off from the federal code will be how we decide as a state to sort of adjust the tax code to reflect family size. I wanted to mention that also there's a lot of different, there's sort of variation in how states calculate their income taxes. So as of 2019, 5 states use federal taxable income. Minnesota is one, but Colorado, Idaho, North Dakota, and South Carolina are the others. Vermont actually, prior to the TCJA, also used federal taxable income and actually moved to FAGI as the starting point as part of its tax conformity legislation last year. 28 states start with federal adjusted gross income. 8 states use gross income or their own definition of income, and then 9 states have no income tax. This slide is just to mention that of the states that have federal adjusted gross income as their starting point, there's a fair amount of variation. So some of them have standard deductions that are smaller than the federal standard deduction amount in tax year 2017, and that was before sort of the federal government made significant increases in the size of the standard deduction. And 9 states had standard deduction amounts that were less than the sort of old federal standard deduction amounts. So I think that among states that use FAGI as their starting point, there's a fair amount of policy variation in sort of how they choose to set the standard deduction amount. And there's reasons I might mention later about why we might want to have a standard deduction that is greater than or equal to the federal standard deduction amount. So I'm going to briefly talk about sort of the provisions of TCJA in particular that affect Minnesota's income tax. Because sort of not everything is, for the reasons we mentioned before, sort of flow through to Minnesota or directly affect our tax. So I'm going to focus on the provisions that sort of matter for us. Before starting, I think it's worth mentioning that many of the provisions in TCJA expire on December 31st, 2025. So unless Congress acts to extend them or make them permanent, we don't really know what's going to happen that far into the future. But if Congress takes no action, the tax system would sort of revert back to the old law tax system in tax year 26. So when we're talking, I sometimes get a little bit loose with the language. I think other people do. So if we say a deduction has been repealed or limited, I think that in law it would say it's been suspended and would come back into place in 2026. And so if I'm loose with language there, I apologize for that. But in general, unless we note explicitly what I'm talking about here, these changes would revert back to old law in 2026. So the first thing I want to mention, I mentioned this earlier, is under old law, taxpayers received an exemption of $4,250, would have received an exemption of that amount in tax year 2019. So married joint taxpayers received 2 personal exemptions. People that filed with another status received 1 personal exemption. Under TCJA, those exemptions are repealed, and the sort of Federal Tax Act made the decision that rather than offering those exemptions, we're going to sort of push more money into the standard deduction. And also for the dependent exemption, all filers received sort of 1 exemption amount per dependent. And as I mentioned before, the TCJA repealed that and replaced it with an expansion in the child tax credit for children 16 and younger, and then a new $500 credit for dependents that don't qualify for the child tax credit. So I think that this is a helpful slide because it sort of shows you what we would have projected the standard deduction amounts to have been in tax year 2019 if the TCJA had not passed, and sort of the amount that you would get by combining your standard deduction and your personal exemptions. So you can see that the standard deduction amounts under current law for 2019 are greater than the combination of your personal exemptions and your standard deduction amounts. but you sort of only benefit from those that increase in the standard deduction if you claim the standard deduction. So if you're itemizing your deductions, you actually don't benefit from the increase in the standard deduction in the same way that you do if you sort of are still claiming the standard deduction and benefit from that net increase.
Mr. Williams, and those numbers, like in the last year, you've got the standard deduction, those are indexed or inflated each year?
Mr. Chair and members, yes, they're indexed for inflation. And the numbers in this table are sort of from taking the state's November forecast inflation numbers and sort of projecting forward what the state thinks would have happened in tax year 2019. And we still care about that in Minnesota because we're connected to sort of the old law standard deduction amounts. So if there's no conformity bill passed this year, these will be the amounts that we are projecting would be in law sort of for the tax year 2019 in Minnesota if no conformity bill is passed. And the federal bill actually changed the inflation indexing to use sort of a slower measure of growth called chain CPI. I'm going to talk about that a little bit later. But these amounts sort of right here are indexed using the old measure of inflation CPIU.
Representative Schultz.
Thank you, Mr. Chair. For the TCGA for children 16 and younger for the child credit, was that always the case that the age was 16 and younger? Or did TCGA change the age?
Mr. Williams.
Mr. Chair and Representative Schultz, yes, that was the rules sort of prior to the TCJA. And I think that because the category of a dependent sort of was much larger than just children 16 or younger, so that would include potentially college children that are away at school that you still claim as a dependent for tax purposes. And maybe there's some cases where you might have an adult in your family with a disability that you sort of have as a dependent, and that person would have qualified for the dependent exemption. So by sort of shifting to the child tax credit as the main family size adjustment, that was sort of the, I think, impetus for putting in place this $500 credit for other dependents that sort of replaced the dependent exemption amount.
Mr. Williams.
So next I'm going to talk briefly about changes to itemized deductions. There's sort of a lot of them, and I think that it's worth mentioning that if the state retains federal taxable income as the starting point for our income tax code and we conform, then we would adopt these changes unless we sort of made an explicit decision to not conform on particular itemized deductions. And if the state were to decide, and I mentioned that this decision to potentially move to adjusted gross income as the starting point for our tax code because last year all three of the omnibus tax bills passed by the House, Senate, and Governor sort of made the decision not to stick with FTI. But if we were to switch to FAGI, sort of following what the legislature and governor proposed last year, we'd sort of have to make a decision to define what we allow in Minnesota as itemized deductions. And so we could potentially sort of adopt the new TCJA definitions of itemized deductions, and that has sort of a simplicity benefit for the state. And I'll talk a little bit about the policy trade-offs there. But on the other hand, we could also decide we want to define our own itemized deductions that have nothing to do with the federal government or are tied to the old law itemized deductions.
Mr. Williams, just a little discussion on this. I was looking ahead, and I don't know if you have the marginal tax rates in here. I don't think you cover that. But just when you talk about behavior, so it might be the mortgage interest deduction and so forth, if you talk a little bit about the difference between the federal government because of its tax rates versus the state income tax with its class rate or marginal tax rates as far as kind of where you get the most benefit from and a little bit of the difference there.
Representative Mark Gordon, members, I think that generally sort of the marginal effect of the itemized deduction, sort of how much of a benefit it provides to the taxpayer, sort of depends on what marginal tax rate they're paying. So if I'm paying the 39%, or I think it's 37% now, federal top marginal rate, sort of if I have $1,000 and in mortgage interest that I'm deducting, that would be worth $370 to me in tax savings because my marginal rate is 37% and I'm deducting $1,000. The state top marginal rate in comparison is 9.85%. So that would have a benefit to me of about $98.50. So in general, I think that, an economist would say that the federal rates have probably a more powerful incentive effect than the state rates, just because they're a deduction or an itemized deduction under federal law gives you sort of a bigger financial incentive to make sort of that deduction than than a deduction that's allowed under state law.
Thank you.
So the first itemized deduction I'm going to talk about is the mortgage interest deduction, which I just mentioned. TCJA made 2 changes to it. First, prior to TCJA, you could deduct interest on home equity loans if sort of regardless of how you use the home equity loan money. So you could, take out a home equity loan, pay for a vacation with it, and that would be deductible as mortgage interest. So TCJA said you can no longer deduct interest on home equity loans unless it's used to improve your principal residence. So it sort of gets rolled in more to the general mortgage interest deduction, which is tied to your principal residence. The second thing TCJA did was reduce the amount of acquisition indebtedness, is the sort of term of art here, eligible for the deduction. So prior to TCJA, essentially you could take out $1 million mortgage and interest on that mortgage would be deductible for the purposes of the mortgage interest deduction. The TCJA limited that to $750,000, so it kind of shrunk the amount of the size of the mortgage that would qualify, but it only did so for mortgages incurred after December 15th, 2017. So if you had a $1 million mortgage that you signed in November 2017, it would still sort of qualify for the old law amounts. So sort of the revenue effect of that is smaller in the short term and phases in over time as sort of a larger share of the total mortgages that are out there fall after that December 15th, 2017 date. TCJA also repealed the casualty and theft loss deduction, which is a deduction for if you essentially losses that to your home or vehicle or other significant property that were not covered by insurance. And that deduction was limited. It was only for the amount of the losses is in excess of 10% of your adjusted gross income. TCJA also increased, so this actually made this deduction more generous, the charitable contribution deduction. So prior to TCJA, you were limited in the number of charitable contributions you could make to 50% of your adjusted gross income. And TCJA increased that limit to 60% of adjusted gross income. TCJA also sort of modified the taxes paid deduction, also known as the state and local tax deduction. Businesses would retain the right to deduct taxes at the entity level, so taxes that were imposed or assessed at the entity level. So a business could still deduct an unlimited amount of property taxes as a business expense. But individuals are limited to deducting $10,000 if you're a married couple filing joint returns and $5,000 if you're a married couple filing separate returns of state and local property tax, income tax, war profits or excess profits tax, and that limitation is not indexed for inflation.
Representative Joachim?
Oh, thank you, Mr. Chair. On that first bullet point on retaining the deduction for businesses, how does that affect folks that are doing a pass-through with their individual income tax credit instead of a corporate tax?
Mr. Williams?
Mr. Chair and Representative Joachim, so if you're filing as a pass-through entity, essentially you can deduct at the entity level a tax that's assessed at the entity level, but the individual income tax, because that's assessed at the individual level, you're still sort of limited there, if that makes sense.
Thank you.
Mr. Williams?
So, Mr. Chair and members, I'd also mention that this provision probably has a larger effect on federal tax liability than on state tax liability, because you can't deduct your state taxes on your state taxes, which means that we were already kind of adding back your state income taxes when you were filing in Minnesota. And so this limitation primarily affects people with more than $10,000. For the purpose of state taxes, it primarily affects people with more than $10,000 in property taxes. So if you have more than $10,000 in property taxes, you would be limited to deducting just $10,000 for state purposes. TCJA also is a little bit confusing, but under old law, you could deduct medical expenses in excess of 10% of adjusted gross income. In tax years prior to 2017, the floor for the medical expense deduction was 7.5% for taxpayers ages 65 and older. And TCJA actually lowered that AGI floor, so it actually made this deduction more generous to 7.5% for all filers regardless of age, but effective for tax year 17 and 18 only. So for tax year 19, the tax year that we're sort of going to file next year, the medical expense deduction floor would be 10% of adjusted gross income for all filers. The last thing TCJA did, and I would argue that this is one of the more consequential of these itemized deductions, sort of in terms of revenue, is it repealed what on the Schedule A were called miscellaneous itemized deductions. So it's sort of 3 lines on the Schedule A. There's tax preparation expenses, unreimbursed employee expenses, and expenses for the production or collection of income, which are also just called miscellaneous deductions. And essentially, these 3, the way that these deductions work is you would add together your total amount of all of these 3 categories of things. It would be subject to a 2% AGI floor, and then you'd be allowed to deduct the amount in excess of 2% of adjusted gross income. So that deduction was suspended till 2025 or repealed sort of in the short term under the TCJA.
Representative Lean.
Thank you, Mr. Chair. Does that also include expenses people may incur if they're self-employed? I see unreimbursed employee expenses. I just assume that that is if they do have an employer, but if they're just self-employed or they do contract work, does that fall in that category?
Mr. Williams.
Mr. Chair, Representative Lean, it doesn't include self-employed individuals. It's people who are employed or who are employees. So some of the individuals you might have heard, there's testimony last year in committee from people who work as construction workers and who pay their own way to travel to a construction site and don't get reimbursed by their employer for that cost. That'd be an unreimbursed employee business expenses. We've heard from traveling sales persons who go out and sort of travel a lot and pay for their own lodging or transportation costs and aren't reimbursed by their employers. There's things like employee uniforms that are not reimbursed by their employers or paid for by their employers. So it's those sorts of things. And then, again, because there's this 2% AGI floor, it's probably people that have a pretty large quantity of that. 2% of their income is more than 2% of their income is represented by these sorts of expenses that are not covered by their employer.
Thank you. Please proceed.
So, one of the larger consequences of TCJA is that people who were itemizing previously are sort of being squeezed on both sides to sort of move towards the standard deduction. So I just mentioned a bunch of ways that your itemized deductions under TCJA were limited, and at the same time, your standard deduction increased pretty significantly. So that's sort of, it's not surprising that we think that a lot of people that were previously itemizing their deductions at the federal level will probably switch to claiming the standard deduction. So our modeling indicates about, under old law, about 64% of returns would have claimed the standard deduction federally, and 36% would have itemized their deductions. And after TCJA, we sort of estimate that that would go up to about 88% of returns would claim the standard deduction. So it's only a pretty small number, about 350,000 returns in Minnesota that will itemize at the federal level. That's a pretty big shift in sort of how taxes will be filed for a lot of people. And the other sort of, a consequence of more people claiming the standard deduction instead of itemizing is, I mentioned last week in our presentation that Minnesota has a subtraction for charitable contributions for people who claim the federal standard deduction. So under current law, if you claim the federal standard deduction, Minnesota will allow you to subtract sort of 50% of your charitable contributions in excess of $500. And so as a result of more people claiming the federal standard deduction, we think a lot of people, assuming we retain FTI as our starting point in Minnesota, a lot of people will end up benefiting from this non-itemized or charitable contribution subtraction. So when I did some modeling on this last week, the amount of the subtraction was forecast to increase about 361%, just to give you an idea. And that's sort of a function of people who were previously itemizing, claiming the federal standard deduction, and then instead of getting the benefit of the itemized deduction for charitable contributions, they would end up getting sort of this state non-itemizer subtraction. Another change under TCJA that was is that the federal tax system moved from CPIU, the Consumer Price Index for all urban consumers, to the Chain Consumer Price Index for all urban consumers. This measure of inflation sort of accounts for the ability of consumers to change their consumption habits when price increases, just by substituting goods, that have gone up in price for cheaper goods. And Chain CPI, sort of the effect on the tax system is that it increases more slowly than CPIU, which means that provisions that were indexed for inflation under, that are now indexed for inflation under federal law would grow more slowly than they did under current law.
Representative Joaquin.
Thank you, Mr. Chair. How does that affect, you say it's a slower growth. Is it even slower than IPD inflation, or is it about the same? I know they're apples to oranges because one's services, one's products, but I'm just wondering.
Mr. Chair, Representative
Williams.
Joachim, I'm not actually sure sort of how the relative growth rates of those two measures of inflation. I think that I'm not going to speak on that without
Okay,
certainty,
no
so
problem.
I can follow up with you after that about.
Thanks.
I know when levy limits have been put in on cities, we've used the implicit price deflator, which tends to measure government purchases and so forth. So that's a good question. I don't know how that would differ for sure, but we'll find out. So, Mr. Williams.
So, sort of the effect on the tax code of using chain CPI instead of CPIU is that many provisions, income thresholds, those sorts of things will grow more slowly than they would have under old law. So that means that the brackets will creep up less quickly, which means that more income will be subject to the higher rates of tax. For things like credits that have income phase-outs or phase-ins, those income phase-ins and phase-outs will grow less quickly and those sorts of things. So it sort of ripples out through the tax code, and it mostly has an effect of raising revenue. And this change is permanent, so this is not one of the changes that would expire in 2025 under TCJA. And so under current law, because Minnesota hasn't conformed to this change, sort of Minnesota's income tax code continues to be indexed using CPIU and at the old inflation rate. And it's sort of a policy choice that the committee and the legislature will have to make about whether or not that's a change they want to conform to. I just put in a few other sort of high-level changes under TCJA that would affect Minnesota. TCJA exempted from the income student loans that were discharged due to death and disability. So previously, that was counted as income because it's discharged debt. So that's no longer the case. Section 529 college savings plans. TCJA allowed about up to $10,000 per taxable year in distributions from 529 accounts to be used to pay for elementary and secondary school tuition. There's also sections of TCJA that establish these opportunity zones. So the governor's declared certain census tracts in the state of Minnesota to be opportunity zones under this law, and there are tax incentives for making investment in those zones. So if you have a capital investment that and you have not realized the capital gain, you can invest the amount into one of these opportunity zones and sort of defer paying income taxes. And depending on how long you leave it invested in this zone, you may actually just get a full 100% exemption from capital gains taxation.
Okay.
So I'm going to talk briefly about sort of some of the higher level policy choices that are facing the committee. I would say that the first one, and I've alluded to this several times now, but should the state retain federal taxable income as its starting point? And I'll talk a little bit about the reasons you might want to do that. And sort of should the state adopt the TCJA's itemized and standard deduction changes, or should we shift to FAGI, define our own rules for itemized deductions, define our own standard deduction amounts? A related question is, under either approach, we're going to have to probably come up with some sort of family size adjustment to sort of replace the repealed dependent exemption, because that's just not, that's being handled at the federal law level through a credit. And so that's just something that's not going to pass through to the state under any circumstances. We're going to have to define our own family size adjustment. I think there's a decision about how to conform to, whether or not to conform to chain CPI as the inflation measure for the state. And sort of, I would say, balancing simplification with winners and losers. So just with the magnitude of changes being made at the federal level, there's probably going to be shifting in winners and losers. And there's a simplification benefit to adopting the federal changes and accepting them for Minnesota purposes. But adopting those changes, sort of getting that added simplicity, comes at the cost of adding winners and losers. People that used to claim these deductions or claim the full amounts of these deductions will see them repealed or limited. I want to talk briefly about reasons you might want to retain FTI as the state's starting point, or reasons you might want to switch to FAGI. So the biggest reason to retain FTI is that it's a simplification measure. we wouldn't have to define our own standard deduction. We wouldn't have to define our own itemized deductions. We'd sort of adopt the federal rules for those things. They'd flow through to Minnesota. There's also a possibility that if we define our own standard deduction amounts, it could create a Minnesota-only tax filing requirement for some taxpayers, because taxpayers who have income that is equal to or that is below the combined amounts of, or the federal standard deduction amounts don't have to file a federal tax return. But if our state standard deduction amounts are lower than that, there's a group of people that would have income above the Minnesota standard deduction amount, but below the federal standard deduction amount. And those people would have to file a Minnesota-only return. So that might impose a burden. Some people would probably be upset about that. The federal law established a large standard deduction amount. It's, as I showed you earlier, it's a pretty significant increase when combined with the elimination of the exemptions. And I think that that's a big simplification measure that we could adopt. It eliminates the need for taxpayers to keep records of all these itemized deductions. You don't, because it's sort of just, we're assuming everyone's going to get this standard deduction amount, and that amount reflects your charitable contributions, it reflects your mortgage interest, reflects your property taxes, and those sorts of things. And so there's there's a simplification benefit of incorporating that on the state level. And to the extent that you think that the federal itemized deductions are having an important policy effect, it sort of reinforces those incentive effects. So if you think that the mortgage interest deduction is an effective tool for encouraging home ownership, or the charitable contribution is an effective deduction, is an effective tool for incentivizing people to make charitable contributions, then adopting the federal itemized deductions sort of adds an extra state incentive for those behaviors. So if you think that those are good policies, then you might want to sort of enhance or broaden those incentive effects. Reasons you might want to switch to FAGI is that, so one of the benefits of using FTIs I've mentioned several times is it had sort of a built-in family size adjustment, and it no longer does. So either way, the state is going to have to establish a family size deduction. So like one of those simplification measures of using FTI as our starting point no longer really applies. I'd say that retaining FTI would result in probably significant numbers of winners and losers. People who claim the standard deduction would stand to benefit from that. I would say people who itemize in general probably stand to lose, particularly people who continue to itemize after the conformity bill, because itemizers don't benefit from the increase in the standard deduction amount, and they probably would see their itemized deductions limited somewhat. FAGI as a starting point would give Minnesota policymakers sort of more control, more tax policy levers at their disposal. We could adopt a higher standard deduction amount than the federal government. We could adopt a lower one. We could say we like these federal itemized deduction changes or we don't like them. We could say we think we want to have a credit instead of one of the charitable contribution credit instead of a charitable contribution itemized deduction. So there's more policy flexibility that is provided to the state, but that comes sort of at the cost of simplicity, because we're no longer just sort of following calculations made by the federal government. And lastly, if you disagree with sort of the Congress's policy choices on deductions and exemptions, you might want to sort of reenact those at the state level. So maybe you don't like the ways that some of these itemized deductions or the personal exemptions were limited. You want to reenact those at the state level. That'd be a reason to change.
Mr. Williams, you know, many of those individual income tax provisions end in 2025. So how would this impact, whether or not you were with FTI or federal adjusted gross income, how would that impact things if the federal government did not extend past 2025 those provisions in law now?
Mr. Chair and members, so presuming we retained FTI as our starting point, we would sort of be dependent on the federal government to define what itemized deductions are allowed. And so if there's pretty significant changes coming in 2025, if the changes to the deductions are not extended, then potentially Minnesota's itemized deductions could change quite a bit when we roll into tax year 2026 after those provisions expire. And alternately, if they are extended, then it would sort of create a problem of Minnesota on a year-to-year basis having to pass conformity bills to either adopt the extension of some of those changes or not adopt the extension of some of those changes.
And if we were with federal adjusted gross income?
Mr. Chair and members, to some extent it would depend a little bit on how the law is written. I think that you could potentially write into law definitions of itemized deductions that sort of disregard, I guess, the expiration of some of those itemized deduction provisions of 26. So you might have a little bit of a capacity to avoid some of those extender issues.
Representative Petersburg.
Yeah, thank you, Mr. Chair, and Mr. Williams. Are there states out there that have built-in automatic following of the federal levels at various, or deductions at various things, or most of them, like Minnesota, that there's a static point in time when we impact our taxes?
Mr. Williams.
Mr. Chair, Representative Petersburg, there are states that sort of are rolling conformity states. It's somewhat of a legal issue. Mr. Clayman might remember the name of the case, but there's a Supreme Court case in Minnesota that says the legislature has to proactively act, that we sort of can't delegate the tax decision-making to the courts on that, or we can't delegate future decisions about tax policy to sort of the federal government.
Representative Petersburg, did that answer your question?
Yeah, no, I was just curious, how, if there were states that were doing it and the parameters of that, and that answers it enough.
Thank you. Mr. Williams.
Mr. Chair and members, I'm going to talk briefly about the changes to itemized deductions and reasons you might want to conform to them or not. So the primary reason I've mentioned before is simplification. When you're trying to figure out how much mortgage interest someone has, you don't have to go through a separate calculation for Minnesota purposes. You could just take the number off of their federal form. You may also believe that some of the policies were ineffective or inefficient in achieving whatever policy goals were sort of behind those itemized deductions. So you might think that to the extent that those deductions were limited, that's a good thing. And then another reason to conform might be that you think you can raise revenue by conforming to these sort of restrictions on the itemized deductions. And then you might want to use that for other tax policies that sort of have a broader based effect. So you could reduce rates, you could increase the standard deductions, those sorts of things. Reasons you might not want to conform is that it's going to create winners and losers. The people that benefited from the sort of more generous itemized deductions at the federal level will probably pay more. To the extent that to the extent that the itemized deductions were increased under federal law, people might win under that. And you may also believe that these deductions were effective or efficient policy mechanisms, and you don't think that it's a good idea to limit or restrict them. I would also say that to the extent that you conform, it's for people that claim some of these deductions, there may be significant tax increases at the state level on them. So the unreimbursed employee expenses that Representative Lean mentioned earlier, people that have a lot of unreimbursed employee expenses might see a pretty significant tax increase by fully conforming to that change. I'd say that there's sort of two obvious ideas about how you might go about establishing some sort of family size adjustment, although I'm sure that there's more that I'm not imagining here, but I wanted to just sort of briefly touch on some possibilities. So one option that was sort of enacted, that was a part of all three of the omnibus tax bills, the House, Senate, and Governors from last session, was just to establish a Minnesota dependent exemption that replicates the dependent exemption that was available under old law. One benefit of doing that is that it doesn't create winners and losers relative to old law. We're just putting back into place what would have happened if TCJA hadn't happened. To the extent, compared with the credit, which is the other option I'm going to discuss briefly, an exemption, sort of the value of that to a taxpayer depends on what the taxpayer's marginal tax rate is. And so that's part of the winners and losers concept. The exemption is more valuable to taxpayers with higher marginal tax rates. Also, the personal exemption or the dependent exemptions were phased out in Minnesota for individuals, married couples making about $292,000, which mitigates somewhat the value for higher income people because they start to lose their dependent exemptions at very high levels of income. But to some extent, that's sort of a policy choice about whether you'd like to continue it. But there's a little bit more complexity baked into that as well. State child tax credit would probably be more progressive. It would provide an equal benefit to taxpayers regardless of their marginal rate. But it would also create winners and losers because if it was enacted in a revenue neutral fashion, because people with higher marginal rates would end up getting a less generous benefit from this, and people with lower marginal rates would get a more generous benefit from a credit than they would have gotten from a deduction. This is maybe a higher level slide, but I think that this is sort of useful trade-offs to keep in mind in talking about a conformity bill. But probably any conformity bill passed by the legislature is going to create winners and losers. To some extent, we can model who those winners and losers are using the income tax model that we have in the House and in the Department of Revenue. But the modeling doesn't capture all the effects that provoke different provisions of the law. So Mr. Clayman is going to talk next about the business provisions, and effectively none of those provisions are captured by the individual income tax model. And to the extent that we conform on some of the base broadeners on the business side, that's likely to create winners and losers. And there's not really a way that we can pass a conformity bill that doesn't generate large numbers or significant winners and losers. A conformity bill is also probably likely to reduce the simplicity of our tax code no matter what, for the reason of we're going to have to define our own family size adjustment, which means we can't sort of just adopt a federal family size adjustment like we were under old law. And I'd say that there's a lot of policy trade-offs between these different courses. So I think that some of the competing values in here are simplicity, equity, both vertical and horizontal equity, ease of administration, transparency, economic efficiency, and revenue adequacy. A lot of these policy goals or tax policy goals are intention, and I don't think that there is any option in making a conformity bill that sort of checks all of these boxes. You're going to face trade-offs between these different values, sort of depending on which direction the committee wants to go. And from there, I'm going to hand it over to Mr. Clayman to discuss the business provisions.
So before we do that, Mr. Williams, I want to focus on what you're talking about on the modeling. And so last year, when the governor and the House and Senate were talking about, the number of kind of winners and losers and trying to certainly minimize the number of people who would see tax increases as we try to do this conformity, that did not include business pass-throughs. Is that correct?
Mr. Chair and members, yes. The income tax model that the Department of Revenue and that we use in the House as well doesn't have the capacity to model the sort of base broadening business provisions.
So thank you, Mr. Williams. So I think that's really important for people to understand because there's going to be tax increases on business pass-throughs, as you're going to see here with the base broadening that the Tax Cuts and Jobs Act did. And so when we try to talk about the modeling and trying to keep everyone held harmless, it does not include the business pass-throughs, which was not included last year as we were talking about things. And so if the goal of the committee is to try to hold everyone harmless, that may be a goal unattainable as we conform to what the federal government did, because the changes were so, of such a high magnitude on businesses and the deductions that's just, it's almost impossible to be able to hold everyone harmless. And I just think that's maybe good for everyone to realize. Even as good as the picture was last year when you heard about, none of them got down to zero, but where it was very few number, it still was not counting the business pass-throughs, which Mr. Clayman's going to talk about on some of those provisions, and you'll see kind of what the Tax Cuts and Jobs Act did regarding businesses. So, Mr. Clayman.
Mr. Chair, for the record, I'm Chris Clayman with the House Research Department. So moving on to the business provisions of the TCJA, I think the first one we'll look at here is the qualified business income deduction. And just to step back for a few minutes, under the TCJA, the corporate rate was cut significantly. It was cut by 40% at the federal level, from 35% to 21%. And the qualified business income deduction was an attempt by Congress to try to do something then for the pass-throughs, who pay, as we discussed last week, pass-through entities like partnerships, LLCs, sole proprietorships, or S-corps. They don't pay an entity-level income tax like the corporate franchise tax, for instance, in Minnesota, or the corporate tax at the federal level. That income is passed through to the individuals, and the individuals pay an individual income tax. They were not benefited by the corporate rate cut at the federal level. So the QBI, as it's called, is a way to, at least in part, make or put those pass-through, people that own pass-through businesses on a footing that's equal to or close to what corporate taxpayers got. And this is a brand new provision. Nothing like this has been done before under federal law. Essentially what it does is that it allows owners of pass-throughs to deduct 20% of their qualified business income. This is subject to a variety of interacting limitations regarding how much income you're making, the type of trade or business that you're engaged in, your wages paid, qualified property. And there's a threshold here where if you're over a certain threshold of income, you cannot take the deduction if you are in a certain trade or business. But if you're below the threshold and you are in that certain trade or business, you can take the deduction. So it's very complicated at the federal level. This is also a very interesting business provision in the sense that it's a hybrid provision. It does not affect, or it's not an above-the-line deduction, but it's also not an itemized deduction. So it affects FTI. And it's a deduction that happens after the determination of adjusted gross income. There's also provision under the QBI, the new section of federal law, section 199A, that has the QBI deduction for agricultural co-ops and horticultural co-ops. It's slightly different. There's actually two separate deductions, but potentially they could both add up to 20% in some cases. So that's a QBI. Yep, moving on to section 179. This is the expensing provision. Essentially what section 179 does is it allows businesses to deduct the full amount of capital expenditures on machinery and equipment and certain qualified property in the first year that that property is placed into service. And that's the expensing part of that. Otherwise, you'd have to deduct the value of that property according to a depreciation schedule. So this is depreciable property that's allowed to be deducted. And the depreciation schedules could be, 3 years, 5 years, 10 years, 15, depending on the type of property. The TCJA made the Section 179 expensing provisions more generous. So you can now deduct much more property in the first year that it's placed in service. And then you see the thresholds here. The limit is now $1 million in property, and that begins to phase out at $2.5 million dollar for dollar. So the way that this works is once you get up to $3.5 million in total capital expenditures, your Section 179 deduction, allowable deduction, is zero. The TCJA also changed the types of property that qualify for Section 179, and this is sort of key to thinking about how the state conforms to Section 179 in whole or in part, and whether that's going to be retroactive or not, and we'll get into that in a later slide. But just for now, just note that the TCJA changed the types of property that qualify, or that could qualify for TCJA. And when we get to bonus depreciation in the next slide, that's actually a much bigger deal. Minnesota is not currently in conformity with Section 179 and has not been for over, I think, 10 years, maybe 15 years now. And what you have to do in the state level is you have to take, instead of taking the full deduction in the first year the property is placed in service, the state actually requires you to take that deduction over the course of 6 years. So it's 20% in the first year and then 1/5 of the 80% in the next 5 years.
Representative Schumacher.
Yeah, thank you, Mr. Chair. And I just had a question. I was wondering if you could help and explain what the deduction is for the Section 179, what that is on and how that plays in for trade on equipment.
Mr. Clayman, Mr. Williams.
So, Mr. Chair, Representative Schumacher, so I believe with the trade-ins, you're looking at like-kind exchanges. Section 1031, and Mr. Chair, Representative Schumacher, I don't have the like-kind exchanges in my slides here today, so I think what I have to do is just follow up with you later after the fact,
Okay.
just to go over what some of those changes were. But
All right. Thank you, Mr. Chair.
You bet, thank you. Mr. Clayman.
so moving on to bonus depreciation. Bonus depreciation is similar to Section 179. It's taken after the 179 deduction. So first you do Section 179, then you do bonus depreciation. And it's just a further deduction for depreciable property. The TCJA changed the bonus depreciation rules to also make them much more generous. Instead of only being able to deduct 50% of the value of a property in the first year it's placed in service, the TCJA now allows 100% to be deducted in the year that's placed in service. A major change, so that's a big change. Another major change with bonus depreciation is that more property is allowed to qualify, and that includes used property now. And so that's can potentially be a very large universe of property that now qualifies for bonus depreciation. And again, as I noted in the last slide, this becomes an issue when you start thinking about how to conform, if you want to conform, to these cost recovery provisions under Section 179 and bonus depreciation. Bonus depreciation is a temporary provision. This will phase out beginning in 2023. And as you see on the slide, essentially we treat bonus depreciation in the state the same way that we treat Section 179 depreciation.
Representative Lean.
Thank you, Mr. Chair. Under this bonus depreciation, let's say a piece of equipment, loses value every year. Are you able to then take 100% of that reduced value every year, or is it just a one-time depreciation when you acquire it, if it's used, or how does that work?
Mr. Clayman.
Mr. Chair, Representative Lean, so you're able, I guess this is good to clarify, for bonus in Section 179, what you're able to do is deduct 100% of your basis in the property in the first year that property is placed in service, and the basis is typically just the purchase price of that property and can include some other things. Outside of Section 179 and bonus depreciation, you have to deduct the basis in the property over the course of a number of years, depending on the type of property it is, under the depreciation schedule. So for property that, for instance, has a depreciation schedule because of its, estimated lifespan of, say, 10 years, you would then, deduct a certain portion of that initial purchase over the course of 10 years. And the real value of expensing, so the real value of deducting 100% of your basis in that property in the first year, is the time value of money. So if you can deduct 100% of the value of the purchase price of a property in the first year it's placed in service, that's worth a lot more than deducting that over the course of 10 years.
Thank
Mr.
you.
Clayman.
So I think we'll move on to the loss limitation rules. And another word that's used for this change to the business provisions in the TCJ is excess business losses, or the excess business loss limitation. I think the best way to summarize this, and you can certainly read what's on the slide, but the best way to summarize this is, in the past, you could take a business loss and you could deduct that against both your business income and your non-business income, or your active income and your passive income. So if you had passive income, you could take a loss that you had from your active income, from operating a trade or business, and you could use that to offset the income for your passive, or offset your passive income. And what the TCJA did with the EBLs, the excess business losses, is what they're saying is you're only going to be able to deduct your business losses to the extent of your business income. Plus, then the feds kicked in an extra $250,000 on top of that. So essentially, you cannot offset more than $250,000 of your passive income with losses that you have taken by conducting a trade or business in terms of your active income. I don't know if I'm being more or less clear than what the slide has. So in other words, you can no longer offset all of your passive income with losses from your active income. And that's essentially what's going on with the loss limitation rule and the changes to excess business losses.
Representative Gomez.
Thank you, Mr. Chair. Could you just explain active versus passive income, please?
Mr. Clayman.
Sure. So active income would be under the federal Internal Revenue Code definition if you're materially participating in a trade or business. So you're actively managing an enterprise, for instance. You're in the office every day, you're doing the work. Passive income would be, say, income that you earn from an investment in real estate. And that's kind of a special case. But another case might be if you're, say, a silent partner in a partnership. You're just an investor and you're not actually participating in, the day-to-day, management activities of the business. That would be passive income.
Representative O'Neill.
On the slide, it talks about carry forward. Can you just talk just a little bit about how they handle the carry forward now?
Mr. Clayman.
Oh, right. Oh, yep. Mr. Chair and Representative O'Neill, that's a good reminder, and I did skip over that part. So the disallowed amount, so the amount that you can't take as a deduction under the new EBL rules, you can still carry that loss forward, but you have to do it as a net operating loss under the new net operating loss rules, which we'll get into as well. So you can still take those deductions. You just have to do it in a subsequent year.
Mr. Clayman.
The TCJA changes. The TCJA made some changes to accounting methods and accounting reform. There are the two main approaches to accounting. There's the cash method and the accrual method. Federal law prior to the TCJA allowed cash accounting to be used in some limited circumstances. That's typically viewed as a much more simple way to do accounting. And the TCJA allowed a broader range of taxpayers to use cash accounting for tax purposes. And again, this is typically seen as a much simpler and administratively easier method than accrual method of accounting. The gross receipts test changed from 5 million to 25 million. So now if your gross receipts don't exceed $25 million, you can now use cash accounting. And there were some other changes as well that happened. On the state level, the Department of Revenue actually determined that under state law, that taxpayers are able to use whatever method of accounting can be used at the federal level. So essentially what happened last year is that there's been almost an administrative conformity to this provision. So the next here is the interest deduction limitation. This is the business interest deduction. And under prior law, business interest was deductible. The TCJA now has imposed limits on that. Essentially, the limit is 30% of a taxpayer's adjusted taxable income. So that's a pretty significant limit on the amount of business interest that can be deducted. Adjusted taxable income is, for people who are sort of familiar with accounting, it's similar to earnings before interest, taxes, depreciation, amortization. So it's essentially just looking at the income of the business before that business has made tax planning and accounting and other financial decisions. There are some exceptions to this, however. One big one is for car dealerships. So car dealerships can continue to deduct the interest that they pay on the loans that they've used to purchase the inventory for those dealerships. And I think we'll move to the next slide here. I guess one other thing about the interest deduction is a lot of people see that in relation to section or to the expensing provisions, the more generous expensing provisions. There's tends to be a relationship between the generosity of or at least one theory is there's a relationship between the generosity of the expensing provisions and the generosity of the business interest deductions. Those two are sort of theoretically linked to some extent.
Representative Fabian.
Thank you, Mr. Chair. Mr. Claim, I'm curious, that final bullet point on that slide talks about car dealers, and obviously that has to do with inventory. Does that, are other businesses that have large amounts of inventory, an implement dealership, RV, any business that has large inventory, are they able to use that deductibility as well?
Mr. Clayman.
Mr. Chair, Representative Fabian, I believe that it is motor vehicles. So inventory of motor vehicles. So anything that's anybody who sells motor vehicles would be able to take advantage of that exception. So not just the car dealerships, an RV, motorcycles. But I would, that's what I think. I'll double check that, and if I'm incorrect, I'll get back to you and the committee about that.
Thank you.
Okay, thank you.
And also some small businesses too are exempt from that too if they are under an average of $25 million in the last 3 years. Net operating losses. There's some pretty big changes to the NOL rules at the federal level. Under prior law, you could, you had what's called a 2-year carryback on your NOLs, which meant that if you had a loss, say, for 2019, you could file an amended return, and you could apply that loss to offset your income in 2018 and 2017 and get a refund for those years. You could also carry that loss forward for up to 20 years. And you could take the amount of loss that you could take in any given year, it just couldn't exceed your taxable income. So after the TCJA, the net operating loss rules have changed significantly. That 2-year carryback has been eliminated, and you are now limited to taking only 80% of your taxable income per year from a net operating loss. Although now under federal law, you can now indefinitely carry forward those net operating losses instead of being subject to the 20-year limit. Minnesota's corporate NOL provisions, we have never conformed to the feds, to the federal to the Internal Revenue Code with corporate NOLs. So the corporate NOLs are limited to 2-year, they don't have the 2-year carryback currently, and they're limited to 15 years going forward. Employer deductions. So this is, just to clarify, this is different than the unreimbursed employee expenses provision that Mr. Williams talked about. This would be the TCJA's limitations on the deductions that an employer can take for certain fringe benefits, specifically meals, entertainment, and certain qualified transportation fringe benefits. And under previous law, some meals were 100% deductible, some were 50% deductible, depending, if you have a business lunch with somebody, or your employer the employer provides meals on company premises for the benefit of the employees. Those were deductible. Entertainment expenses were deductible. I believe it was 50% deductible. And certain qualified transportation fringe benefits like transit passes, van pools, and parking benefits were also 100% deductible to the employers. So the employers could deduct 100% of their costs associated with providing these benefits. The TCJA changed those rules for employers, and now pretty much, and I think this slide probably could be clarified a little bit. But now meals generally are 50% deductible, entertainment expenses are not deductible, and the qualified transportation fringe benefit deduction was eliminated. Now, the reduction or the elimination of these employer deductions does not mean that those benefits are now taxable to the employees. So they do not need to be included in the compensation of the employee under the TCJA. So, Mr. Chair and members, we'll move on to the repatriation tax. This is one of two what are called the international provisions. And there is, Mr. Williams just informed me, it's the third bullet point. There is an error in the fiscal year number. In the printed slides only, yep. But the number on the screen should be accurate. Oh, there is just no number on the screens. Okay. So really the repatriation tax, it should really be seen in combination with the next slide, which is it's called GILTI, or the Global Intangible Low Taxed Income, or a tax on or GILTI, a tax on GILTI. What Congress is doing with the repatriation tax, there's probably a little background here that might be helpful. Under prior federal law, if you had a controlled foreign corporation, you had a foreign corporation that was earning income, and it was, say, a subsidiary or related to a domestic corporation, that foreign corporation did not have to recognize its income, so it could defer its income on the income that it earned until it actually returned that income to the United States, so until it repatriated it. And this sort of corresponds to a big change that the TCJA was trying to make in terms of moving from a federal taxation system of worldwide taxation to a territorial system. Worldwide taxation being you're taxed on all your income, but you get to worldwide income, but you get to defer some of this income that's being held by a foreign corporation to a territorial system where your foreign income is exempt from taxation. What happened over the years, at least according to Congress, is that a lot of corporations were able to move, essentially shelter some of their profits in low tax countries overseas and defer that income and avoid paying the tax on that income until it was repatriated to the United States. And what the repatriation tax does is it says, as we're transitioning from a worldwide system of taxation to a territorial system of taxation, we're going to deem a certain percentage of that income to have been repatriated to the United States, whether it actually is returned to the United States or not. And then Congress imposed a tax on that deemed repatriated income from those foreign corporations who had or were deemed to have held deferred income. And so that's what the repatriation tax is. It's a tax on that deferred income that's been held. And it goes, and Congress reached back to 1987 and said everything after 1986 until 2017, all the deferred income has to essentially, you essentially have to pay a tax on all that deferred income. The tax is imposed at a somewhat preferential rate, depending on the type of assets it is. If it's cash, it's, I believe, 15.5%, and for other assets, it's 8%. Or is it, that may be the GILTI. Okay, yep. So that is, yep. And so that's what repatriation is. When it comes, the federal government, the Congress said that this is going to be treated like subpart F income, which is also another way that previously existed under federal law to try to discourage the deferral of foreign income. And when that income comes back or is deemed to have come back to the United States, it's treated as Subpart F income. And it's then treated, under current law, it would be treated as a dividend. And it would be subject to Minnesota's 80% dividend received deduction. And then it would also be further reduced by Minnesota's apportionment percentage under the corporate franchise tax. So that's how the repatriation tax works. It really works in conjunction with the tax on GILTI, which is the next slide. One other quick note on the repatriation tax, and this is a lot of information, but because the repatriation tax is assumed to encourage some corporations to actually return some of this income as dividends, the Department of Revenue has estimated that even absent the state conforming with this particular provision, that will raise revenue. Because once those dividends are actually returned, they become income. We don't need to do anything. They become taxable income, and we don't necessarily need to do anything to be able to tax that income. So moving on to the next slide, global intangible low taxed income, or GILTI. Some people think Congress may have had a sense of humor when they they named this particular tax, but repatriation is basically looking to the past and saying, you've used some of these, you've deferred income in these foreign corporations in the past, and that has to end. GILTI is the forward-looking provision. So GILTI says, we're not going to let you do this again, especially now that we're moving to a system where we want to exempt your foreign income from taxation under a territorial system. And so GILTI is intended to discourage corporations from deferring income, and typically in low-tax countries, Ireland or Bermuda or somewhere. And so the way that GILTI does this is, and again, this is treated similar to Subpart F income as repatriation was. GILTI is basically a portion of a foreign corporation's income that is assumed, essentially, assumed to be attributable to income that really should be domestic income. So in other words, there's a formula that's used that uses a 10% rate of return, assumed 10% rate of return on assets held by that corporation. Anything over that is assumed to be, in this population of gains that should properly be attributed to a domestic corporation. And so that's the tax base, and then the tax is imposed on that income as determined under this complicated formula. Again, GILTI, if we did nothing, it would come into the state as Subpart F income. It would be treated as a dividend. It would be subject to the 80% dividend received deduction. The rate for the rate of tax on GILTI is the corporate tax rate of 21%, but there's a 50% deduction that also happens for GILTI. So effectively, the tax rate is 10.5% on GILTI. And so another question for members to think about in terms of conformity is, if you conform to GILTI, do you want to conform to GILTI before or after that deduction? So moving on then to the foreign derived intangible income provision. This is also known as FDII, is how people say it. But there's sort of a carrot and stick approach here under the TCJA. GILTI is the stick, and FDII is the carrot. FDII is the provision in the federal tax code now that tries to reward people or incentivize businesses to export, essentially. And again, there's a complicated set of calculations that determines the deduction that you can take under FDII. Again, conforming to this, of course, would allow this deduction for Minnesota purposes because it affects, it would reduce FTI. And then we'll move on to the next slide. I guess before talking about this next slide on retroactivity, I would just mention that unfortunately there's a missing slide, and the missing slide talks about some of the potential legal issues that could come up with respect to taxing guilty and repatriation. Essentially, under the Foreign Commerce Clause, a state cannot tax foreign earned income in a way that's different than the way it taxes domestically earned income. It can't discriminate against foreign commerce. So depending on the way that the state actually conforms to guilty and repatriation, if it does, if there's a difference in the way we treat it, and that difference means that we treat or that we would impose more tax on repatriation or guilty than we would if we, say, pulled those companies into the unitary group and treated them the same as domestic income under the corporate franchise tax, we could, the state could potentially risk litigation on the subject, on the constitutional issue, and there's a lot of money at stake. So it's possible that it's a real possibility that this could happen, and there has been some talk, among some businesses who'd be subject to guilty that they do intend to sort of scrutinize how states are conforming to these provisions. But I guess the one caveat here is that these issues are still pretty unclear. The TCJA is very complex, and the legal issues involved here are very complex as well. There's also, I guess I have that on another slide. There's even a case that mentioned, it was an Iowa case, the Kraft case, and in that case, Iowa was treating foreign income in a discriminatory way, but it was part of Iowa's attempt to conform to some of the, or link into some of the corporate provisions that the federal government had enacted. So even if the state is conforming to a federal taxing system, the courts could still step in and say, you still have to abide by this anti-discrimination principle in the Commerce Clause. So that's just a risk. It's unclear exactly how big the risk is, but it's there. So moving on to retroactivity, there's some extra complexity with conformity this year on these business provisions. Because the state didn't conform last year, so you now have a year where you've had some businesses taking certain deductions under the TCJA at the federal level, but for state purposes, to the extent that we're linked in to the old federal code, those same deductions and losses were taken under the old federal code for purposes of looking at what those tax benefits would be for state tax purposes. And one of those differences is, we mentioned before under bonus depreciation in Section 179, there's different property that qualifies for expensing now. The used property for bonus depreciation, for instance, and then there's some extra qualifying real property under Section 179. What this means is that for purposes of those expensing provisions, there are business taxpayers who were able to, at the federal level, for purposes of 179 and bonus depreciation, they were able to deduct not only the full amount under federal law, but also the full amount on a broader range of property. And then for 2018, those same taxpayers would, of course, be subject to the lower amount of the first year deduction under current law, and they'd have to narrow the range of property for state purposes that they can take under Section 179 and bonus. And so this creates some questions when you think about, when members are thinking about how to conform to these provisions. If we conform retroactively, taxpayers would be able to, either on a voluntary or mandatory basis, go back and amend their 2018 returns to sort of sync them up with the types of property that can be depreciated at the federal level. Of course, that adds a layer of complication too if you go back and amend those returns for 2018. But if you don't do that, then you've got sort of a double complication under the expensing provisions. You have, of course, the state, not conforming to the 100% deduction in the first year, plus you have this other range of property. So do you want to conform retroactively to that? The situation with the net operating losses is even more complex. Potentially you could have taxpayers that are reporting a loss in 2018, and under the Minnesota rules for NOLs that reference the old federal code, they will have filed an amended return for 17 and 16 to get a refund. And then they're able to carry forward those losses for 20 years. Retroactive conformity to NOLs would mean filing another amended return, paying back the refund. But the alternative, not conforming, is with those net operating losses, those are then going to affect, then the question is, how do you administer those net operating losses going forward? They affect federal adjusted gross income, but they would really, you'd be looking at two different federal adjusted gross income amounts. One under the old federal code for purposes of taking the state net operating loss, and then the federal adjusted gross income amount under the TCJA. And so I don't necessarily expect everyone to follow that, but the point is that's a significant administrative complexity.
There's some complexity there.
Very complex. And retroactivity can solve some of that complexity, but retroactivity also has its own complexities, and it can be a hard thing to tell people to do. Pay us back the refund that you got in the last couple of years. So again, you could do voluntary and mandatory amended returns if you wanted to go retroactive on some of these provisions. You could also do what are called catch-up provisions, which you have a taxpayer do a addition or subtraction in the current year to put them in a position they would have been had we conformed retroactively. Again, that's also administratively complex. But also repatriation is deemed repatriated in tax year 2017. Taxpayers are then able to go through to elect to choose an 8-year payment plan to pay that back over the next 8 years. But if you want to conform to the repatriation tax, you probably retroactively have to go back to 2017 on that particular provision. I guess just sort of, getting out of the details and the weeds and getting up into the broader policy considerations, I think probably the biggest conformity issue for the committee for the legislature is, if you decide to conform to a lot of these base broadeners, how do you, quote unquote, want to spend the money? So if you decide to conform to these. Mr. Williams talked earlier about increasing the standard deduction. So, I don't know if he talked about that, but that's one possibility you could do, is you could increase the state standard deduction. Well, you could use the base broadener money to do that. You could do that. You could also use the base broadener money to increase a family size adjustment that Mr. Williams talked about. There's also an opportunity, if you wanted to keep the business-based broadeners in the business world, there's also an opportunity to either do full or partial conformity on Section 179 or bonus depreciation. And the other thing, of course, you could do with the base broadeners, you could reduce the corporate rate. So if the base has expanded, should the rate go down? These are just examples of what you could use the base broadener money for. There are more, but this is just sort of put out there for your consideration. There are potentially a lot of ways to use the base broadeners if you decide to keep them. And just the last note here, some of this money is one-time money, so the repatriation money is one-time money. Potentially there's budget risk if there's a permanent expenditure that's not scaled down to the amount of permanent money that's coming in through the TCJA. So, and that's, Mr. Chair, members of the committee, that's the last slide. So.
Mr. Clayman, thank you. Representative O'Neill.
I just have sort of a in the weeds kind of question real quick. So you had talked about a lot of the business expenses that you can deduct, but you didn't really talk about something that a lot of small businesses have, which is space in their home. They deduct part of the mortgage, they deduct part of the utilities because they use a home office or something. Did that change at all?
Mr. Clayman.
Mr. Chair, Representative O'Neill, I don't believe that any of that changed through the TCJA.
Before we leave the corporate rate change, I've heard from some farmers who are organized as corporations. It's a small percent, but there are that would be under the lower marginal rate of 15%, where there used to be 4 corporate rate marginal rates, I believe, from 15 to 35%. And they would be in on the 15%, but now since there's just one rate at 21%, they're actually seeing an increase if they also qualify again under what would have been the 15, the 21. Is that an issue we need to look at? Are you hearing that? I'm hearing that from some of my CPA folks working with farmers.
Mr. Chair, I think I was conferring with Mr. Williams here. I think I'll shoot that over to Mr. Williams.
Mr. Williams?
Mr. Chair and members, I believe, based on your description, it seems likely that maybe their incorporation status has changed, because I believe there was just one corporate rate
Right.
prior to for C corporations prior to TCJA, and that didn't necessarily change. But if they had potentially changed how they were incorporated, they may have, previously been filing as pass-through entities with the different rates, and now that they would have one corporate rate under TCJA.
Thank you. Mr. Klayman?
But Mr. Chair, Representative Marquardt, we can kind of dig into that a little bit more too.
Thank you. Representative Davids?
Well, thank you, Mr. Chair. There's a line in the movie John Wick 2 where Winston says to John Wick, he says, "Jonathan, what have you done?" That's kind of where we are on the conformity issue right now at this point. And I don't look backwards, but we took care of all this last year and a bill that was vetoed by the governor. It's all taken care of. We shouldn't be sitting here doing this today, but that's the past. Mr. Chairman, I pledge to you that when it comes to conformity issues, as history has shown, both parties do work together. This is a lot more complex conformity than we're used to. Usually there's about 8 extenders and we pass them and everybody goes out to the downtowner and has supper and it's all done. This is much more complicated than that. We're really messed up for 2018, but that's where we're at. So I just want to pledge to you, Mr. Chairman, that on the conformity issues, we do want to work with you to see what we can work out here, because this has really put a lot of Minnesotans with some real trouble when it comes to tax time. But that being said, I'm upward and onward and forward. And when it comes to conformity, as I said, the history around this place is both parties work together, because to conform really benefits all Minnesotans. So this is going to be a little more complicated than usual, but we'll make it.
Chair Davids, thank you for those very wise comments, and I agree. I mean, we need to do this bipartisan and fashion, and it is much more than some of the extenders we've done in the past where it might impact 3 to 7% of the filers. This is going to impact almost everyone, so we've got to make sure we do it right. Before we take just a couple final comments here, look in your packets. There's some bills that I have referred to the Property and Local Tax Division. That is in your packet. It also will go on to the committee website. So, Representative Fabian, did you have? Okay. Anything else for the good of the order? Mr. Williams? Mr. Klayman, thank you. Ms. Templin, we will come back to you tomorrow and look at the numbers, how all these things that were talked about today, how that applied to numbers and proposals last year in the House, the Senate, and the governor's bills. And also those who would wish to testify. I think we have about 15 on the list right now. If there's more, please contact Mr. Jessen. So with that, thank you much. We are adjourned.